Welcome back to this Money Control live stream. You're watching Opening Bell with me, Nandita Khemka. It's a Wednesday morning, and the global cues are looking fairly mixed. But yesterday, we saw a deep sell-off when it comes to the broader end of the markets. 3% cut coming in on both the mid and small cap indices. In fact, the broader market has shaved off over 6% in just a matter of 2 sessions. Even the headline indices for that matter. Yesterday, the Nifty saw a 1.5% cut. We tested that 23,000 level as well. But managed to shut shop above that level. But 22,800, that would be the January low. Crucial to watch out for whether or not we manage to defend that level in this leg of sell-off or not. Lots of these mid-cap stocks have shaved off as much as 40 to 50%, even 60% from their all-time highs. And the Realty Pack in particular has entered the bear market, a 26% correction from its all-time high, and so goes for the metal pack and PSU banking index as well. Both these indices have shaved off 26% and 20% respectively from their all-time highs. We'll have to see whether or not we manage to see some bit of green on the screen today or not. But going by the GIFT Nifty, it is hinting at a mildly higher start. But yesterday as well, we were working with positive cues when it comes to the GIFT Nifty. But what we saw was a downward move and a very fast move on the downside. So let's see how things really pan out today. And of course, lots of stocks will also be in focus. MSCI Standard Index, has seen some additions and deletions and weight adjustments as well. We'll be highlighting those stocks, and we'll also be taking stock of the likes of Vodafone Idea and Lupin that have reported numbers. Your stock related queries, please keep them coming in. We'll try and take them up as well. But let's quickly take a look at the top headlines at this hour then. Stocks closed mixed on Wall Street after Fed Chairperson Jerome Powell says policymakers are in no hurry to cut interest rates further. The Dow and S&P 500 see minor gains while the Nasdaq corrects. All eyes will be on CPI inflation for the month of January. Asian markets trade mixed as the Fed signals it is in no hurry to cut rates further and re-emphasizes its focus on curbing inflation. The GIFT Nifty is suggesting a higher start for the Indian market. Crude prices extend gains with the Brent hitting $77 a barrel over threats of sanctions and concerns over the supply of Russian and Iranian oil. The gold rally pauses as prices cool off from record highs on profit booking. CPI inflation for the month of January is expected to come in at 4.53% vis-a-vis 5.22% in December, with food prices expected to ease. Core CPI is expected to remain flat at 3.7% vis-a-vis 3.6% in the month of December. And Finance Minister Nirmala Sitharaman is unfazed by the recent rupee depreciation, says other developed and emerging market currencies have fared worse. Also adds that state governments have not spent 1 lakh crore rupees sanctioned by the centre and urges the states to spend more. And looking at the cues for trade then, we saw a 5th straight day of decline on the Lal Street yesterday. The BSE listed companies in fact erased market cap of nearly 10 lakh crores yesterday. Broader markets, of course, very close to entering the correction zone. The mid-cap index is down 17% from its record highs. FII selling continues unabated. FIIs have sold shares worth 1 lakh crore rupees in 2025 so far. And if you see the kind of selling that has come in since October, they have pulled out, as much as 3 lakh crore rupees from the Indian market. Of course, a lot has to be blamed on the dollar strength as well and rising yields in the United States, especially after Trump's victory. Aside of that, just talking about some of the mid and small cap indices, stocks rather, 30% of the mid and small cap stocks are either at or near their 52-week lows. Yesterday, we saw Eicher Motors emerging as the top laggard. Numbers were a miss and the stock clearly got punished for that. Escorts is the other one that, saw an earnings miss and the stock clearly got hammered. There was a big selling in new age companies as well. You saw Swiggy, Fintech, Zomato, all of these falling somewhere around 8% or thereabouts. Even though Nykaa reported good set of numbers, we saw the stock ending the day in the red. In terms of put call ratio, it fell to 0.69 vis-a-vis 0.75 in the previous session. Manappuram Finance, that is the stock that will remain in the FNO band for today as well. And for yesterday in particular, foreign investors sold shares worth almost 4,500 crore rupees. Domestic investors continue to remain net buyers. They bought shares worth 4,000 crores in the cash market. Today, the AMFI data will also be coming out, so all eyes will also be on that SIP figure for the month. But on that note, let me bring on board our technical guest for today. Joining me is Rajesh Palviya, Senior Vice President Research, Head and Technical Derivatives at Axis Securities. Rajesh, lovely chatting with you, but the texture of the market hasn't been all that lovely, so to say. 23,000 broken on the downside, on an intraday level, although GIFT Nifty hinting at a positive up move. But what is the setup like on the charts? Are we already in the oversold zone, or do we have to go some more distance before we enter the oversold zone?
Good morning, Nandita. Yeah, so it was intense selling pressure in the previous day, and there was panic across the board from investor as well as from the traders as market has sharply corrected and went below 23,000 level also on the intraday basis. But in the last half an hour of trade, some recovery was there, and Nifty managed to close about 23,000 level. If we go with the data setup, yes, we are in oversold trajectory for near term as well as for the short term structure. We are almost now trading near to the previous swing low of 22,800, from where we have already witnessed a one pullback rally towards 23,700 zone. And again, now we are moving back to the same level. The major put-based concentration for this weekly expiry is placed at 23,000, followed by 22,800. So I think this is a zone where important support is placed, 22,800 to 23,000. This is the zone where important support area, confluence of parameters are there to support the market here. Looking at the market texture, we believe some pullback action cannot be ruled out from the current level. Stop loss to take a trade on the long side is 22,800. That stop loss needs to follow for near term perspective. If he breaks below 22,800, this down move can extend further. Though FII supply is still there in the market, but looking at the oversold trajectory, there could be some pullback action in today's session. GIFT Nifty is also indicating some positive opening. So I think 23,150 is the first hurdle after opening. If we cross those level, then rally can extend to 23,250 to 23,300 also. To play this up move, I think one should focus on 23,100 call option, which was closed at around 109 rupees. Keep your stop loss at around 60 rupees. Upside target 180 to 200 for this call option, as we are anticipating that some pullback should be there in the market, as we are already in oversold trajectory, and there was some put based concentration is holding the ground at 23,000. For Bank Nifty, if we look at the Bank Nifty structure, it's now trading near to the crucial support area of 49,200. If we breaks below 49,200, then furthermore downside can be there in the Bank Nifty. But for intraday perspective, if in the today's session, if we hold 49,200, some pullback cannot be ruled out in Bank Nifty also, and possible rally can extend to 49,800 to 50,000. That's the supply zone for the market. But again, after the opening, we have to watch whether we sustain about 23,070 level or 23,100 level, whether we able to cross or not.
Well, we are getting the first ticks, and we are around about that 23,070 mark. Flat open, but of course we have opened with a negative bias. Midcap index, down 0.4%. Of course, the texture is towards the downside today as well. I think 6th straight day of weakness on Dalal Street. But let's see whether or not the selling doesn't intensify from here, because it's already almost a 0.5% cut on the mid cap index. Although the advanced decline ratio is even Stevens at the current juncture, but it's still tilted towards the laggards. 1:1, that's the advanced decline ratio. 716 advances to 772 declines. The Nifty, around that 23,050 to 23,070 mark. It is trying to hold on to these levels as of now, but let's see how things really pan out. The Bank Nifty, we did see a green tick, but failed to sustain that, and now it's a 100-point cut on the Nifty Bank Index. 49,300 is where it's at. I want to see what some of the sectors are doing, in particular the realty pack that has come under a fair bit of pressure. In fact, it has entered the bear market territory as well. 26% to 27% kind of a sell-off or kind of a loss from the all-time highs. In terms of sectors then, most of them are trading in the red, but IT pack is holding out, and so is the metal pack. Both these sectors are trading with gains of somewhere around 0.5% or thereabouts. PSU Bank Index also, after consistent selling, some bit of green there, flat but with a positive bias. In terms of realty, another 0.8% kind of a downtick. So no respite when it comes to the real estate pack. It has been witnessing intense selling pressure, and it continues today as well. In terms of individual movers then on the index, yesterday we just had 4 gainers on the Nifty, and Trent happened to be among them. I don't really know what Trent is doing right now, but in terms of laggards, I can see some of these auto names dominating the laggards list: Hero, Moto and M&M. ITC is the other one that's in the red. Reliance Industries as well in the red. Axis Bank, some of these stocks like Reliance and Axis Bank have seen their weightage reduce on the MSCI index. So some bit of weakness can be attributed to that as well. Apollo Hospital continues to be in the red. Yesterday it was among the top laggards. Bharti Airtel, here as well the weightage on MSCI index has been reduced. HDFC Bank under pressure, so is Eicher Motors. It was a big laggard yesterday. Asian Paints, IndusInd Bank. So yes, a lot of these heavyweights are trading with cuts. But as I mentioned, IT pack is holding out, and the metal pack as well. So you have names like TCS, Tata Steel, Hindalco, HCL Tech, Tech Mahindra, Wipro. All of these are holding out. Tata Motors as well today. Some strength, 0.5% gains in an otherwise weak market. Looking at the open, Rajesh, 23,000. That's intact as of now. How would you approach stock picking? Any recommendations?
I think Berger Paint can be looked at as a stable structure for the stock, and since last couple of weeks we are seeing some recoveries taken place in this stock. Looking at the near-term structure, stock is holding above 50-day, 20-day moving average. So I think Berger Paint can be looked at for upside target of 510 with stop loss of 478. Another stock that is on the short side, that is DLF. DLF is still weak in the weak trajectory, and we have witnessed most of the real estate stocks have corrected in last couple of days. Looking at the structure for DLF, I think if it's remain below to the level of 715, I think furthermore supply pressure towards 685 we can see in the DLF. So DLF on the short side, Berger Paint on the long side. For Nifty, I think after opening, I think Nifty is trying to get some buying action here, but let's see in next 10-15 minutes how the behavior pans out, whether we able to sustain about 23,000 level or not. If we able to hold out this level for next 10-15 minutes, I think some pullback can be there in Nifty also, but 23,000 needs to watch closely in next 10-15 minutes.
Okay, yes, you're right, 23,000. As of now, we are clutching onto that level by the skin of, in fact, the Nifty is clutching onto that level by the skin of its teeth, but whether we can defend it or how long it can defend that level, that's something we'll be watching out for. Berger Paints, you mentioned, the stock is in focus. I think it's up somewhere around 2.5-3%. Given the fact that volume growth has been fairly okay in a weak demand environment, but profit has seen a 1.6% downtick and revenues have risen 3.5%. Margins have also come in sub 16% levels. So 15.9% vis-a-vis 16.7% in the same quarter last year. But we were talking about banks, Rajesh, and I can spot a query on a Kotak Mahindra Bank on our feed coming in from Anand Swaminath. He wants your thoughts on a very short term basis, but this stock has been outperforming when it comes to the private banking names. do you think it's the start of an up move? Can it move higher from here, or how are you approaching the stock now? And for the very short term, what's the outlook?
Market is, under pressure, but Kotak Bank, if we analyze the structure, the stock is clearly holding the ground at higher level, and stock is comfortably holding above all its near-term, short-term moving averages. If you want to buy at current level, I think you should follow for trading point of view, your stop loss should be placed at around 1870. That level needs to watch closely in the near-term perspective. If it's able to sustain above 1870, yes, there could be some outperformance in this stock. And on the higher side, 1970 is the level where we may see the target going forward. But follow the stop loss of 1870, as market are still not giving any kind of signal for reversing at this juncture. So I think stop loss needs to follow for any trading position you are initiating at this juncture.
Okay, that's the view on a Kotak Mahindra Bank. Hope that answers your query. I want to get in your thoughts on the two-wheeler pack as well. Eicher Motors came under intense selling pressure after numbers. Today as well, it is extending its losses. Although on a YTD basis, it has outdone its peers like Hero and Bajaj Auto. But TVS Motor continues to do well, right? So between these two, what would you pick? Because TVS Motor is in the news today. Just want to read out what the news flow is. The company has signed an MOU with the Karnataka government to invest 2,000 crore rupees over the next 5 years. The company is gaining traction as a EV player as well. So between the two, Eicher and TVS, which charts are looking better right now? Because both these have outperformed the rest.
I think if I want to pick, I think Eicher would be my choice, as overall long-term structure for Eicher Motor is still on the bullish side. Stock is still holding about to long-term moving averages, though there is some supply pressure in near-term chart. But I think till the stock is holding above 4900 level, trend is likely to exhibit on the bullish side for near-term to short-term perspective. And on the high side, once the stock manages to cross above 5050, 5070 level, then I think some short covering action cannot be ruled out in this stock. So Eicher would be my choice if I have to pick from Eicher or TVS. Your stop loss should be placed at around 4900.
Okay, place your stop loss around 4900 when it comes to Eicher, and chartically, Eicher in a better place compared to TVS according to Rajesh. IRCTC, that's the other one that reported numbers. The stock is down 1% or so. Profit up almost 14%. Revenue has seen a double-digit growth of 10%. Margins have contracted a bit, 34% vis-a-vis 35.5% or thereabouts on a YY basis. Railway stocks have seen quite a lot of pressure. Some of these stocks have shaved off as much as 40% from their highs. In that sense, how are you viewing IRCTC? More downside, 740 or thereabouts. That's where it's at. In fact, I think it came very close to its 52-week lows today. Do you see the floor lower than 52-week low on this stock?
Yeah, trend is on the negative side only. Series of lower top, lower bottom formation in the stock since last couple of months. Weekly, daily chart are clearly indicating that there is no as such buying interest at this juncture for IRCTC, and the way stock has broken its previous swing low. Also, we believe that further more downside we may see in the near term perspective. On the downside, yes, the next target is 700, 680. We may see on the downside until the stock not crosses above 760, 770 zone on a weekly closing basis. Sell on rise would be the strategy for IRCTC. So structure is weak. I think those who wants to buy should wait as stock is still under downtrend for near term to short term perspective.
Rajesh, before I move on to queries, I want to get in your thoughts on a Sterling and Wilson. That's, I think, the biggest small cap laggard. If you look at the stock movement, it has shaved off 60% from its all-time highs. What do you do with a stock like that? Would you advise like booking losses and getting out of this counter for whoever is stuck in this?
Stock clearly in the downtrend, and now stock is approaching towards its October 2023 swing low. So almost stock is now moving back to the last 2 year rally. Uh, I think stock is in oversold trajectory. Any pullback should be used as an exit opportunity in the stock. On the higher side, the major steep resistance is placed at around 350. So I think if you get any pullback towards those levels, should be exit opportunity in the stock. On the other hand, if stock slips below to 270, I think furthermore cut towards 250, even 240 zone can be there in this stock. So overall structure is weak. Try to exit in any kind of pullback if you get in the near term perspective.
Okay, exit on pullback. That's the view on a Sterling Wilson. But let's shift focus and take some viewer queries. Then, uh, I want to see a query on ABB and Siemens. This one's coming in from Rupak Mehta. He's making a loss of 15% on both these stocks. What should he do? Capital goods, how is that poised? And these two stocks, if he's making a double-digit loss here, how should he navigate?
ABB, Siemens, Cummins, all three stocks are under, supply pressure. If I go with the structure, Siemens is still, looking bearish, and we believe that despite of this much of supply, if it's breaks below 5100, I think Siemens can continue furthermore down move, and possible down move can extend to the level of 5000, even 4950 kind of level for Siemens. So 5200 is the stop loss to remain short in the Siemens. ABB is also looking weak as the stock is slipped below to 20-day moving average, and continuously whatever minor pullback we are getting in this stock are sold off. So looking at the structure, till stock not crosses over 5500, sell on rise would be the strategy. On the downside, 5200 is the immediate target where we may see this stock can slide further. Even Cummins is also bearish. The way stock has slipped below to 20-day moving average, and the pullback which we have witnessed in the last week again sold off. The major steep resistance is at 3000 level. So until the stock not able to cross 3000 level on a weekly closing basis, whatever minor pullback you are getting in this stock should be used as a shorting opportunity. On the downside, 2700 is the first level, and if it's break below 2700, the next target is towards 2550. So still there is no relief after the market opens, and I think uh, market is again, now broken the below 23,000 level
Hmm.
for Nifty also. So that supply pressure is
Yeah.
still continue in the market. So despite of oversold trajectory, there is no relief till now for the market, and I think the texture is still there on the weaker side, and uh, continuous supply pressure is likely to be there in the market if we not crosses about 23 70 23,100 zone.
Hmm. Yeah, and the mid-cap index is now down over 1.5%, and the advanced decline ratio has worsened. And how? 1:5. That's the NSE advanced decline ratio. Last couple of queries then. Anunay wants to know your thoughts on Avenue Supermarts, DMart. He bought at 4,025, and he wants your thoughts for the next 6 months. He wants to know whether he should hold or exit. DMart, of course, has been under pressure consistently, but on a YTD basis, it has managed to give some meager returns. Whatever reversal it saw over the last month or so, do you think it has more legs to sustain, especially after the tax cut announcement in budget?
Yeah, so despite of a lot of announcement related to the consumption related, theme, and but still the texture of market is not supportive, and again, demand is also witnessing the supply pressure in the market. Though stock is now available in the derivative side also, so short sellers are getting opportunity to short this stock in derivative side also. Looking at the structure, 3800, 3900 are the major supply zone for the stock on the higher side. Until the stock not crosses above 3900, sell on rise would be the strategy. On the downside, the immediate support area or critical support area is placed at 3500, 3470 level. So that level needs to watch in this decline. If it's able to hold those levels, so I think some pullback. But again, if it breaks below that level, selling would be continue, and then possible down move can extend to 3300, 3200 also. Still, structure is weak. Sell on rise, I would suggest until the stock not crosses and sustain above 3900.
Right. Last query then on a Keynes Tech. I can't get the person's name, but wants to know the target for 2025 on this particular stock. Keynes Tech, Dixon Tech, they've come under intense selling pressure after the dream run that these stocks have seen. Keynes in particular has shaved off 35% in just a matter of a month. Any targets here for the rest of the year on the long-term charts?
Are you talking about Keynes, which is trading at around 3970? Okay.
That's correct.
Yeah, okay. So stock is in down move only, and this is the fourth consecutive week where stock is making a lower high low formation. That clearly shows that sustained supply pressure in the stock. Stock is trading below to all its near term, short term moving average, and we believe that if it's remain below to 4100 level, I think possible down move can extend to the level of 3700, 3600. So don't buy at this level. Trend is still weak. Uh, until the stock not crosses above 4100, there won't be any kind of reversal or any kind of pullback would be there in this stock. So sell on rise would be the strategy. Downward target is 3600, 3500.
Okay, 36,000 to 3,500. That's the downward, momentum or target that one can expect on this particular stock. With that, Rajesh, would like to thank you for taking out time and joining in this morning and sharing your thoughts and helping our viewers as well navigate their stock holdings. Look forward to connecting again next week.
Yeah, sure. Thank you.
Thank you. Well, on that note, before I speak to my next guest, I want to just look at what the market is doing. We are staring at another triple-digit cut on the index. In fact, we have broken below yesterday's swing low of 22,986. In fact, we are now very close to 22,950. It's not looking good. Look at the mid-cap index, down almost 2%. So I think the mid-cap index from its highs has shaved off almost 20%. And advance decline ratio keeps worsening. It's almost 1:7 now, 320 advances to 2000 declines on the NSE. Not looking good. How should one navigate this leg of the correction? Let me bring on board our next guest for today, Prakash Diwan, joining in. Prakash, hi. Great to have you on the show. The pop that we saw after the budget really didn't sustain, and the reversal has been pretty fast. And the pace of the downward move is a little scary. How should you navigate? And is this fear around mid and small cap, for real? Should one exit mid caps and look at large caps? How should one really navigate the whole noise surrounding this?
Good morning, Nandita. Oh, you are absolutely right. I think the fall, more than anything else, has been vicious, has been too fast. And that's what's unnerving a lot of investors, and it's natural, it's understandable. There's nothing wrong if you feel anxious and restless about how the stock market has responded, in spite of a lot of the good news that the budget brought in. And I would not take away the fact that the budget is definitely one of the best we've seen in recent years. It will have its impact, but then it will need time to really start manifesting the positive impact. What's happening is simple. You have exits from FIs, which brought the Nifty and the headline indices down. The moment that happens, you start getting a feeling there's something wrong with our market and with our businesses and valuations, and it starts kind of percolating to small and mid cap names as well. And then it keeps cascading from one point to the other, where a lot of margin calls come in. There's a lot of panic. You really don't want to kind of lose capital. And there is a set of investors this time around, and I remember, who haven't seen a fall as sharp as this, as vicious as this. So for them, the big question is, what do you do if stocks have lost 30, 40, 50% from their peaks? And the answer to that is, if the stocks are worthy enough of keeping in a portfolio for the long term, they will bounce back at some point in time. So this is just a number on your on your demat account, which changes dramatically when things look up as well. Uh, if the earnings are good, if the business model is intact, you don't need to panic and fret. But if those things are not in place, then the answer to your question about what should they do if the stocks are down is they should have got out in the first place. They should have not gotten in the first place, and they still need to get out. So there's no explanation. Capital preservation is the only part in investing that you need to master. And these are times which will test that out. It'll give you a real life situation. So I don't think if you really ask me, there's any reason to hold on to stock which are fundamentally not tenable. But if fundamentally the stocks are good enough, the business models are intact, you have absolutely nothing to worry. This is just a passing phase. Things will look up at some point in time. We don't know when, but it will. You just have to hold on till the earnings catch up and the P multiples come back.
Sure, and of course, in this leg of the sell-off, it's the more of the retail crowd, the HNI crowd that has been selling rather than the domestic institutions. But I want to highlight the changes that the MSCI has made to its indices. It has increased the weightage for all these underperformers like Zomato, PB, Fintech, which have already shaved off somewhere around 30% or thereabouts on their stock prices. But stocks like Axis Bank, RIL, Infosys, these are some of the counters that have seen reduced weightage. How do you read into this? Do you get a sense that all the stocks that have shaved off quite a bit from their record highs have kind of bottomed out? Are they poised to make a comeback? Is that why the weight changes have been made accordingly?
No, so I think the weight changes have got more to do with the market cap rotation that keeps happening within the indices, and some of these businesses are fairly new age in that sense, and there is demand, there is a different level of participation that comes in. But some of this very expensive stocks which are trading at multiples which are in triple digits, sorry, in triple digits have actually come down to double digits, but they're still expensive. So from 110, 120 multiple, if today the market is giving it a 65 multiple, whereas it probably deserves a 30 multiple, it's still expensive. So I think the excesses of the market took a long time to build up. 22, 23, 24, we saw a huge build up without any commensurate rationalization on multiples. And now, when that is coming, it's coming thick and fast. So that's the reason why it optically looks very bad. But if the multiples had gradually come down, you would have been very fine and very accepting of it. So my sense is just because MSCI is including something and excluding something, we'll have just a very temporary blip of an impact, Nandita. You know that it's a very small, short-term kind of a thing. You can't really rely on having these stocks in a portfolio just because of that perspective. But yeah, fundamentally, if you're aligned to the business models, the growth, maybe yes.
I want to get your thoughts on a Vodafone as well. It reported numbers, although losses have narrowed, but subscriber loss continues. Average revenue per user has also improved due to the price hike, and also the fact that the company will be raising debt, which could provide the much needed capital for network expansion, as well as 5G rollout. And there are also reports that the government is looking to waive off the AGR dues. Given these factors, do you think Vodafone Idea's outlook is improving, or do you think subscriber losses and funding challenges will continue to pose significant challenges?
So, the fact that they still have losses, which are lower than what they used to incur earlier, tells you that things are not yet, out of the woods in that sense. It's a story that's still in the making. But what's helping is that at least the ARPU increase from the subscribers who are existingly there and using their services, it's actually paying off a lot of the expenses. And that's why you see, look at the EBITDA. The EBITDA has moved about 3.5% on a sequential basis, on a Q&Q basis. Let's not compare it on a YOY basis, because you want to see whether the improvement has already begun to happen and not just a cyclical thing that happens in every quarter, and then you say, third quarter of the year is good, and then it's not. In telecom, that's not the case. Telecom, you need to look at things, how progressively they are improving. And my sense is there is improvement for sure, Nandita. But, it's going to be a long haul for them to be able to get into a stage where they are healthy. subscriber losses is not such a worrisome thing, according to me, as long as their EBITDA keeps increasing. Means that their business is getting much more efficient. Now, if that happens, even with a lower subscriber base, it's absolutely fine. You need to only do what you can do on a balance sheet like this. So it's going to be a long haul. Don't expect miracles overnight. But in this difficult situation, if you look, and when I say difficult, not from a stock market situation, from the telecom space perspective, they've been managed to keep their head above water, and through whatever government support that comes through, I think they'll be able to play a respectable third player of sorts, unless BSNL gets active and these guys have to look at number four as a slot. But at this point in time, I think they are heading for a respectable third slot, which means they'll be around for sure.
Okay, that's the view then. So let's move on to the pharma space as well. How do you think this pocket is poised now, given the fact that we've seen a very sharp depreciation coming in on rupee as well? Numbers have also not been all that bad. Lupin also is the latest one that reported numbers. It looks pretty healthy, and the US business has also done well. Any preference here within the pharma pack? No worries. I was talking about the pharma pack.
Yeah, please.
Can you hear me?
Yeah, I can. Sure. Please go ahead.
I was talking about the pharma. Sure. I was talking about the pharma pack. Is this one pocket where one can look to hide, given the fact that rupee has seen a very sharp fall. Numbers haven't been all that bad, and Lupin is the latest one that has reported numbers pretty healthy. Any preference that you have in this space, the pharma space?
Yeah, so I definitely believe this is one pocket which will give you space to kind of allocate money to a sector that's turning around, that's got some growth impulse. But the only challenge there is, as a sector, this is the biggest in our markets in terms of number of participants, number of constituents. And from that perspective, it becomes very difficult to narrow down on some of the names which will do well, and because it could happen that those names may not do as well, and they'll be moderate and average, and the rest of the sector does well. So you have to be extremely picky about where you are. But I personally feel the large pharma, I mean, look at Divi's Lab. You saw the numbers. Everything was fine. It's just that the market is not in a mood to look at good numbers, bad numbers, and just reward things. But some of these numbers are giving you a very clear indication that things are really, really improving on the ground. And once this dust settles on tariffs, and if pharma as a sector remains resilient to that or insulated from that, I think there'll be a new wave of buying that will happen, a lot of allocation. And certainly, Nandita, once money starts coming back into India, this is the sector that will see a huge amount of interest. So good to be in this sector. Answering your question on specifics, at this point in time, I would not be able to give you very specific names, but the ones that we like are Cipla, Divi's. You'll have to stick with the big names, while the smaller names might still kind of undergo a little bit of time correction.
What about the metal space? As the tariff situation evolves, how are you viewing this particular sector? We are looking at a full-blown trade war, and metal pack, although it was the best sectoral mover last week, we've seen how things have panned out this week. And of course, we also have the crucial meeting between Prime Minister Modi and Trump slated for later this week. If you are invested in this particular space, how do you really navigate?
Yeah, no, so if you're invested in this space, you let Prime Minister Modi and President Trump navigate that for you, because there's not much you can do except for be kind of cognizant of what's happening. Metals as a pack in India, if you look at, I mean, we heard about tariffs on imports into the US. India exports about 2.3 percentage to US on ferrous, and non-ferrous is aluminum. It's about 3. So it's hardly anything that will upset the apple cart for us. But it's a sentimental thing. Whereas here we are talking about ourselves, anti-dumping duties and all of that, so that we don't get impacted by Chinese imports. So I think it will continue for a long time. But the numbers tell you a very different story. Our domestic businesses have grown to a scale which is fairly competitive. They can still keep growing, JSW and all. I mean, the way they are building up capacities at the cost at which they're doing it is remarkable. So I think the benefit will happen because this time the balance sheets are different. Last time when expansion happens, a lot of them actually ended up getting over leverage and pulling themselves down. That's not happening now. And the domestic infrastructure demand itself is robust enough to keep all the iron making this thing going. But I think the valuation comfort also is there. It's just a matter of sentiment and flows, but it's not a sector that
Sure.
people run into whenever things look up. But it will get its fair share of sunshine at some point in time. But I think it's still about 2 quarters away. It's only when the infrastructure spend improves. But the tariffs won't impact. To answer your question more pointedly, I don't think the US tariffs will impact our metal stocks in a major way.
Okay. Things are looking pretty cloudy right now. When you look at the headline indices as well, we are fast approaching the January lows as well. In fact, it's a 200-point cut on the index and an over 2% cut on the mid-cap index, over 1100-point fall as we speak on the mid-cap index. Prakash, I know it's a very bottom approach kind of a question, but do you have any floor or any level in your mind when it comes to the Nifty? Because we are fast approaching 22,800 and looks like we are going to breach that today itself. Very short term, where do you see the Nifty bottoming out?
No, I wish I knew that, and I'm not a chartist to look at charts. I'll do look at
Sure.
charts just to get an idea of the pattern. But let me tell you what happens, why this happens, and if you understand why things happen this way, at least it gives you the sense of being in some sort of a control or knowledge of when certain levels get breached on the way down, which is not the case on the way up when it comes to profit taking. But on the way down, there is a stop loss concept which a lot of businesses, institutions have. And whether you are technically trading or you're positionally trading, it doesn't matter. But if you're sitting on a profit, and if that profit itself starts eroding, there will be people who will want to get out of those trades or those positions. And that's exactly what's happening now. When the Nifty is going to lose ground so rapidly, a lot of that action will kind of see follow through. So I wouldn't be surprised if the Nifty actually heads towards that 22,500, 600 mark. I mean, no, line in the sand of sorts, but that's the kind of sentimental impact that will happen. And once that selling exhausts itself, is when you'll have to give it time for the fresh buying to happen. So mid-March is when things would probably look from a time perspective, flow of news perspective. I think you'll have to wait till first half of March for things to stabilize. Till then, don't look at the screen if you're not a trader and get upset.
Sure, got your point. I think it's better to watch cricket now rather than keeping yourself glued to the screens when it comes to the markets. Prakash, with that, would like to thank you for taking out time and joining in and sharing your thoughts with us. Always a pleasure, and I look forward to interacting again sometime soon.
Sure, thanks.
Thank you. Well, 200-point cut on the index. As Prakash mentioned, mid-March, perhaps that around that time we could see some bit of semblance of normalcy returning. But 22,500, 22,600 on the downside cannot be ruled out on the index. Not looking very pretty. 1:10. That's the advanced decline ratio. Just about 230 shares advancing to 2,200. Declining. With that, of course, we've come to the end of this edition of Opening Bell. Thank you for joining in and being with us. Keep your queries coming in. We'll try and help you navigate your positions as well, and we'll help you navigate the texture of the market as we go forward as well. But join us again at closing bell at 3:30 p.m. and let's hope we see some bit of recovery from lower levels as the day progresses. Thank you. Thanks a lot for watching.